What is technical analysis and why is it important for day traders? Technical analysis is like reading the heartbeat of the market. So instead of relying on news, company earnings, blah, 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 day tradings analyze price action, chart patterns, and indicators to predict where the market is headed next. It's all about spotting patterns and trends that repeat over time. Why does it really matter? Because price movement reflects real-time supply and demand. And when you learn to read the charts, you're essentially learning to speak the language of the market. Think of it like surfing. You're not controlling the waves, but by reading them correctly, you can ride them to profit instead of getting wiped out. What is candlestick charts and how do they help traders? Candlestick charts are your best friend as a trader. Each candle tells you the story about where buyers and sellers did while during that specific time frame. For example, a green or sometimes white candle means buyers won the battle, and a red or black candle means sellers took control of the market. The body of the candle shows its open and close price, while the wicks or the shadows or the tails show the high and low of the session. But here is the real magic. Candlestick patterns reveal market psychology. So, for example, a doji means indecision. Buyers and sellers didn't win. Nobody knows what comes next. A hammer on the other side signals a potential reversal. Doesn't matter if it's from the top or the bottom, but usually it's from the top, from the uptrend. So a hammer signals a potential reversal, and an engulfing candle could mean a strong shift in momentum. Engulfing could be a trigger candle for technical analysis traders to actually get into the trade. If you master these, you will start seeing opportunities before they even happen. What are support and resistance levels and why are they crucial? Imagine you're bouncing a ball inside a room. The floor or support stops the ball from dropping further, and the ceiling or resistance keeps the ball from going higher. That's exactly how price moves in the market. Support is the price level where buyers tend to step in, while resistance is where sellers push the price down. These levels are key battlegrounds, and understanding them can help you plan better entries and exits. If a stock breaks through resistance, for example, it often keeps running higher because sellers are gone. If it breaks below support, it can collapse because buyers have given up. There is no support at the support level, and most people will shift from going long to going short. So if you want to trade smarter, always pay attention to where the support level and the resistance level on the chart is. What is the difference between a trend and a range? And how do I trade them? Trend and a range are often confused. A trend is when the price moves consistently in one direction, uptrend or downtrend, either bullish or bearish trend. In an uptrend, for example, the buyers are in control and makes sense to look for buying opportunities. In a downtrend, on the other side, sellers dominate the market, and shorting the market is usually a smarter decision. A range, on the other hand, is when the price is stuck between support and resistance. It's moving sideways without clear trend. And many traders, including even myself in the beginning, I struggled because you try to trade trends inside a range, which leads to frustration because these trends are not dependable trends. The key here is to trade with the trend when the market is moving and buy low, sell high when the market is ranging. What are moving averages and how do they help in trading? Moving averages are like GPS for price action. They smooth out price fluctuation and show the overall direction of the market. Let's say, for example, the 50-day and the 200-day moving average are popular for long-term traders or investors. But for day traders, usually they focus on the 5 minutes and the 15 minutes, and sometimes even the VWAP indicator, which is the volume weighted average price indicator. When price is above moving average, it's a sign of strength. When it's below the moving average, it signals weakness in the market. That support is not holding up. So one of the best strategies is the moving average crossover. That's most people actually teaching. Most people teaching that, and most people actually starting with the crossover. So when short-term average, like let's say the 5-minute average, the 5-minute moving average crosses over the hourly moving average, it often is a buy signal. When it crosses below, it could mean a sell-off is coming. What is the VWAP and why do professional traders love it? The VWAP, or volume weighted average price, is a secret weapon for professional traders, because unlike simple moving averages, the VWAP takes both price and volume into account, showing where most traders got in. So if a stock is above the VWAP, it means buyers are in control. If it's below the VWAP, sellers are dominating the market. So institutions usually use the VWAP to gauge if they're actually getting a good deal. So when price bounces off the VWAP, it's often a strong trading signal, because if you want to trade like a professional trader yourself, keep your eye on the VWAP, because it's one of the most trusted intraday indicators out there. What are some of the most reliable chart patterns for day trading? Patterns are usually visual footprints for big money. Some of the best ones for day traders include the bull flag, where the price surges up, then consolidates, so it goes up, then consolidates before another move goes up higher. Some people call it two legs up. It's great for breakout traders. The head and shoulders pattern signals a potential reversal when a trend starts losing steam. Then there is a double bottom, where the price finds support level at the same level twice before pushing higher. Recognizing these patterns will help you as a beginning trader to enter with confidence and exit with profits before even the crowd catches up. What is RSI and how does it help identify trade opportunities? The Relative Strength Index, also known as RSI, is like a speedometer for price movement. It ranges from 0 to 100. So when the RSI is above 70, the stock is likely overbought and could pull back. When it's below 30, it's considered oversold and could bounce back up. But here's the trick. RSI divergence is even more powerful. If price is making higher highs but RSI is making lower highs, momentum is slowing down and a reversal could be near. But when using the RSI properly, it can save you from chasing bad trades and help you spot reversals before they even happen. What is volume and why is it so important in technical analysis? Volume is the fuel behind every price move. If a stock is breaking out on high volume, it means lots of buyers are stepping in, making the move more reliable. If it's breaking out on low volume, the move might be weak and fail quickly. So volume also confirms reversal. If a stock, for example, have been dropping but suddenly surges up with a huge volume, that's a sign of big buyers stepping in. Always check the volume before entering a trade. A price move without the volume, in my opinion, is like a car without gas. It won't go far. Now, I understand a lot of people, a lot of trading mentors now saying volume is irrelevant. Volume is not important in today's trading because there's a lot of, dark pools and there's a lot of hidden trades and stuff like that. That's fine, I understand that. But 90% of the trades are still reported with a volume on it. So would you go with the 90% or would you go with the 10%, the dark pools and the hidden trades? I would personally go with the 90% because that's what I trust the most. Can technical analysis predict the future? No indicator or chart pattern or human can guarantee what will happen next. But technical analysis stacks up the odds in your favor. It's not about predicting, it's about reacting based on probabilities. Think of it like a poker game. The best players don't know exactly what card is coming next, but they play the probabilities to maximize their chances of winning. The key to success in trading is mastering risk management, following your trading plan, and sticking to high probability setups. The market will never be 100% predictable, but if you use technical analysis correctly, you will be way ahead of the crowd.
Thank you for watching. Share this with friends and family, and please subscribe.